What's a situation where someone has plenty of money, genuinely wealthy, but can't get a mortgage?
Actually, that happens more than you think. It could be a retired executive, someone who recently sold a business, maybe a high net worth individual who manages their income strategically. It's basically someone with significant assets, but really have no current W-2 or income, and a conventional lender telling them no. You see, there's a specific program built for exactly this profile. Most people, including a lot of financial advisors, have never even heard of it.
Before we get into the program, who actually experiences this problem? Who is this person?
Three profiles come up most frequently. There's the retiree who spent 30 years building wealth, has a substantial investment portfolio, retirement accounts, real estate, but stopped drawing a salary when they retired. From a conventional underwriting standpoint, they have no qualifying income. You see, the bank looks at the W-2 box, sees nothing, and says, sorry, can't help you. The second one is the business owner who just sold their company. They might have had a significant cash event, maybe 2 million, maybe 5 million, but the income from that business is gone because the business is sold. So right now they have no current employment, and the conventional system doesn't have a clean category for this person. And then the third one is the high net worth individual who manages their income strategically. Maybe they're taking distributions in some years, but not in others. They're structuring things to minimize tax exposure. So on paper, their income looks inconsistent, but in practice, they have more than enough to service any mortgage payment they'd ever consider. All three profiles share the same reality. The financial strength to handle a mortgage is clearly there. The conventional income documentation model just can't see it.
Why does this happen? Why does a wealthy person get denied a mortgage?
It happens because a conventional mortgage approval is built around one assumption, that income is the measure of your ability to repay. And for most borrowers, that's accurate. W-2 income, steady employment, documented pay stubs, that's a reliable signal. And the system works well for that profile. But you see, income's a proxy. It's a stand-in for the real question, which is, can this person service the debt? For someone with $3 million in liquid assets and a $500,000 mortgage payment schedule, the income proxy is completely irrelevant. The assets themselves demonstrate repayment capacity many times over. So you see, the bank is asking the wrong question. The Asset Qualifier program exists because the industry eventually recognized this. It's not a workaround or an exception. It's a product designed specifically for borrowers whose ability to repay is demonstrated through assets rather than income. And Cross Country Mortgage is one of the few lenders that does this program at volume with an in-house portfolio, and we know how to underwrite it correctly.
Walk us through how the Asset Qualifier program actually works and how it's different from what a conventional lender does.
Yeah, so let me show you the comparison directly. A conventional lender looks at the borrower and asks, what is your monthly income? They pull tax returns, W-2s, and pay stubs. If the income isn't there in documentable form, the application stops. It doesn't matter what's in the bank account. It doesn't matter what the investment portfolio looks like. Income only. We look at the same borrower and ask a different question. Do your liquid assets sufficiently cover your mortgage and outstanding debt obligations? If they do, you qualify. So in this case, there's no income documentation, no paychecks, no W-2s. Here's how it actually works. The program looks at your total post-closing liquid assets, what you have left after the down payment and closing costs, and it tests whether those assets meet a coverage threshold relative to your debt. The most straightforward version, your post-closing assets need to equal at least 110% of your proposed mortgage balance, plus 25% of all other outstanding debt. That's it. No monthly income figure, no income calculation at all. The question is simply, do the assets cover the obligations? And if the answer is yes, you have a path. Assets that can count? You've got checking, savings, and even cryptocurrency at full face value. Brokerage and investment accounts at 90% of their value. Retirement accounts at 80% if you're under retirement age, or 90% if you are over retirement age. The discount on the retirement accounts reflects the fact that there would be tax consequences for accessing them. So we don't count them at full face value. Critically, you do not have to liquidate any of those assets. They stay in your account exactly as they are. We're using their existence as proof of financial strength, not asking you to spend them down. Cross Country offers this program up to $3 million in loan amount. Credit scores down to 600, and we can do primary homes, second homes, and even investment properties. And because this is a portfolio loan, we can even get exceptions approved for higher loan amounts or lower credit scores.
Tell me about a client who went through this.
Okay, so retired executive, mid-60s, had spent about 25 years in corporate leadership, built a significant investment portfolio along the way. About 2 years before I met him, he sold equity in a company he'd helped build, a meaningful cash event. At the time we spoke, he had well over $2 million in liquid assets across brokerage accounts and retirement funds. No current W-2 income. So he wanted to buy a second home in the mountains, a property he'd been eyeing for a couple of years. The purchase price was around $850,000. So before he called me, he'd spoken to his bank and 2 other lenders. All 3 declined him. Same reason every time. It was no verifiable current income. His financial had told him that it was going to be complicated, that he may just have to pay cash. Alternatively, we ran the asset qualifier calculation. His liquid assets, after applying the retirement account discount, came to approximately $1.75 million in eligible assets. We ran the coverage test against his proposed mortgage and other outstanding debts. The assets cleared the threshold comfortably, more than sufficient to qualify for a mortgage on an $850,000 purchase. We ended up funding in 24 days. You see, he didn't restructure his finances, he didn't liquidate investments and suffer a large taxable event, he didn't change a single thing about how his wealth was organized. We simply used the right program for his actual financial profile. 2 other lenders told him no. Our program changed everything.
What do borrowers need to go in knowing? Limitations, trade-offs, things to expect.
There's 3 things worth being clear about up front. First, the asset documentation has to be current. Bank statements and brokerage account statements within 60 to 90 days, depending on the program. If the assets are in an entity, trust, or partnership structure, there may be additional documentation required to establish access and ownership. Having organized records before you apply saves significant time. Second, the rate is typically higher than a conventional loan. At the end of the day, you're using a non-QM product, and that does carry a small pricing premium. For most borrowers in this situation, that premium is entirely reasonable, given the alternative is paying cash or not buying at all, but it's worth factoring into the math. Third, and this is something people most don't think about, the program cannot be combined with any other income they may be receiving because this loan does not look at debt to income or DTI at all. So even if someone has various income streams, we ignore them and the loan stands solely on their assets. The conversation is always about what combination of documentation best represents this specific borrower's actual financial position.
What mistake do high net worth buyers make when it comes to mortgage financing?
Not to be trashing my colleagues, but they go to their primary bank first. And it makes intuitive sense. You have a long relationship with your bank. They know your account balances, so you assume that that's an advantage. But in reality, large banks have the most rigid underwriting in the mortgage industry. They're often the least equipped to offer non-QM products, and when they do offer them, they frequently don't have the volume or expertise to underwrite them well. A high net worth individual who gets declined by their bank assumes that's a verdict on their credit worthiness. It's not. It's a verdict on whether they fit that particular bank's particular program, and those are very different things. The other mistake is not having the mortgage conversation when financial planning decisions are being made. If a client is about to sell a business, restructure accounts, or change how they take distributions, those decisions affect what they qualify for and when. The mortgage professional should be in that conversation before the decisions are made, not after.
If someone thinks this might be their situation, what do they do?
Well, first, pull together a rough picture of your liquid assets. Ballpark figures are enough to start. What do you have in checking and savings accounts, brokerage accounts, retirement accounts, even crypto accounts? That picture takes about 5 minutes to assemble, and it's all I need to tell you within 15 minutes whether this program makes sense for your situation. Second, if you work with a financial advisor or CPA, bring them into the conversation early. This is a product that wealth managers in particular should understand because their clients are often the exact profile this program was built for. In fact, they're often ecstatic when they find out we don't have to liquidate investments to pay cash and potentially create a huge taxable event for their client because we can use this program instead. And I'm happy to get on a call with an advisor to walk through the mechanics. Third, don't assume your bank's answer is final. If you've been declined or if you've been told just pay cash, call me before you accept that as the only option.
Where do people find you?
I'm happy to have a free 15-minute call, and you can schedule that on teamaronheim.com. If your situation is like what we described today, significant assets, limited or no current W-2 income, that's exactly the conversation I want to have. You pick the time and I'll come prepared. Or you could just text me directly at 720-200-5464. If you have significant assets and you've been told you don't qualify, or if you haven't asked yet because you assume the answer, reach out. The right program changes the conversation entirely. Let's find out if this is yours.